500,000 that's done annually, only 2% present affordable housing. The other 98% goes towards the high residential luxury type of apartments. What does that mean for a government that's trying to do 500,000 affordable housing? When the State Department of Housing did back of the envelope analysis on how much would it cost them to deliver the 500,000 units by themselves, the number that they saw was 21.3. Last fiscal year's entire budget for the country was quite similar to that number. So it quickly dawned on the National Treasury that, well, guess what? We need the private sector to do this. And not just from the private capital perspective. What they want to leverage is the private sector's expertise, experience, innovation, and capability of actually maintaining the investment that's put in there. So capital is an attractive point, but I think sometimes the bigger picture is lost. Government can easily also sort of go to the market cheaper and get that capital, and we've seen that with the interest rate cap. But what we are trying to emphasize is that the private sector investment is tied to the long-term sustainability, delivery, and efficiency. That's how we create sustainable assets. Now, when the government put this agenda, they put some sort of policy limitations around how to protect affordable housing. Because affordable housing, before it became a before agenda, it was quite a relative term. Affordable housing to me may not be affordable housing to another personnel. So the policy that they gave was tied to the price units, so a limitation to it, and also the target income group, so that there is a delivered target approach towards reaching the people who are quite in need. So we do not deliver 500,000 units and still have a 2% that goes to affordable housing. The task that they gave us was look at doing 3 things within affordable housing. Number 1, find a scheme that brings in private capital but does not impose direct fiscal liability on my books. We have our IMF colleagues who have been quite strong on where Kenya needs to go with regards to its fiscal exposures. So protect us from trying to increase more of our debt to GDP ratio. Number 2, find a scheme that involves the private sector and the private capital that sits within these limitations of price cap in terms of the number of units and also the target income group. But number 3, most importantly, make sure it's attractive for the private sector. So what we did, we held numerous consultative sessions with the private sector, both the debt and equity part, and we also hold numerous sessions with the government, both at the national and sub-national level, to try to understand why exactly is affordable housing not an attractive sector for you? What can the government do? What kind of partnership can the government help towards getting you this? And the private sector said, well, and this was data we received also from our KPDA colleagues and NACHU, who are a big player, and they said, service land is a big component of our development. So not just land, service land. And service in terms of 2 things, hard infrastructure and soft infrastructure. Hard infrastructure, meaning the trunk, related services such as transport, such as energy, water and sanitation, but also the social part, the schools, the hospitals. So it's quite easy to find a parcel of land from where I'm from. I come from the northeastern part of the country. We're sparsely populated, so land is not a problem. Hospitals, schools. So give me a house there for free. I'll not come because I'll need somewhere to take my kids. I'll need somewhere if we get sick to go towards a hospital. So the social component of that land availability is a big chunk as to what the government is focusing on. So when we walked around through the support of our industry experts at the World Bank hired to see what subnational governments might be able to provide a low-hanging fruit towards reaching this agenda, we ran into Nakuru County. They were the first one to come to the fore. That parcel of land, we are all familiar with the big transaction that we all want to do. So at one point, World Bank may be accused of favoritism at some point, but we're all aware of the Nairobi-Nakuru road, right? So smack on the highway, we have a parcel of land, 50 acres, belongs to the county government of Nakuru. And you know the way we always say location, location, location matters? So those requirements of service land in terms of hard infrastructure and soft infrastructure were ready for take within this site. What happens is that when you know, most of us, I believe in the room, are Kenyans, Naivasha is the hotspot of what's supposed to be the development right now. We have the dueling of the Nairobi Nakuru transaction, which I believe our institutional investors are looking towards. So that's supposed to sort of help make sure the economic gains within the area are realized. We also have the extension of the SGR that will be passing around that area. And also, we know that the Ministry of Industrialization is looking towards creating a mega industrial park within that area. And more so, from our Kenya Power colleagues, we know that KenGen is looking towards establishing also a business park within that area. We spent close to 7 months assessing this parcel of land for bankability. And when we say bankability, we are not only looking at financial bankability. We first started answering the question of economic viability. So is this really something that's attractive to the government, first of all? What's the economic return to the government? What's the cost benefit to the people?
Sizable pool of assets. It schemes with a sizable pool of assets. And you can see that we've got a good mixture of public and private sector funds represented. And this is something that we're very keen on, to make this a true public-private partnership in terms of the membership of the composition of our consortium. The formation of KEPFIC, as we like to call ourselves, is a first in Africa, and perhaps even in the world. When the pensions industry in Kenya crossed the 1 trillion mark last year, we said it was an important milestone for our industry. But when pension funds in the country took the initiative to come together and invest together, I believe this is a sign of the pensions industry in Kenya coming of age and maturing. We've had a huge amount of positive coverage in our press, and it's really great to see the media present here today as well. And I think we are perhaps an exception with some of the negativity that we are seeing in the press in Kenya. So this is a positive story, and we're also getting a lot of coverage in the international press, in the financial press in the world. And this, and the presence of so many stakeholders and the interest that is being seen is a testimony, to the high expectations that there are of us as a consortium. Being a new initiative, there are some stakeholders who are perhaps skeptical or may feel threatened by what we are trying to do. This is natural, and we have talked to all stakeholders to allay their concerns. But I think it's important for me to reiterate again that the purpose, the reason for pension funds coming together in this way is this is something by pension schemes, for pension schemes. This is an initiative born out of necessity by pension funds to have a better way of making investments into alternative asset classes, right? This is by pension schemes, for pension schemes. And as the size of the industry grows in aggregate, and as the size of individual schemes increase, it is necessary for us to consider the wider universe of available assets. Having 40% of the aggregate 1 trillion invested in government securities, and having 20% of our total assets invested in listed equities on the stock market. And for most pension funds, their top 10 holdings comprise 90% of their equity portfolio. That is not real diversification. And as we become larger, this is an important thing that we need to look at. And also, we're gaining very little exposure to the real Kenyan economy. And if we believe, and I certainly believe there is a Kenya story, then we're certainly not participating in the Kenya story as a pensions fund industry, and we need to. But we all know that alternative asset classes, particularly infrastructure, are complex. They need big ticket sizes. We need to be big to do that. And therefore, the consortium approach of investing together enables us to consider such opportunities and create the scale needed to invest. But even as we do this, the investment opportunities have to be right. When having discussions about investing in infrastructure, including investing through public-private partnerships, Several of the consortium fund members have expressed their concern over taking on things like construction risks, such as cost overruns, delays, political risk, and the other risks that could impact or even completely wipe out the returns for pension funds. We are very conscious of this concern. And therefore, we are engaging the government, we are engaging stakeholders at the highest levels on how to make some of these investments more attractive to pension funds by reducing or removing some of the risks. And also, we're engaging on the type of instruments that could be created to make it easier to access these asset classes. But we also have to, in turn, got to recognize that there is always that risk and return trade-off. In Kenya, and perhaps in most parts of Africa, we may not have the opportunity to look at brownfield or running projects because there are hardly any. We will have to look at some of the greenfield opportunities that there are there. Now, this brings me on to another important discussion on how best we should structure the consortium. This is not a debate that we will have today, but I want to share some of the things that we are thinking about. Currently, we have a loose association through a memorandum of understanding, but we need to have this formalized if we are to succeed. There are very many different options that we can consider, and there are also different schools of thought on what would be appropriate for us as a consortium. We could, for example, look at investing together on a case-by-case basis. But if there is a pipeline of investment opportunities, we should either consider setting up a fully resourced consortium, having the necessary technical and financial expertise, or consider jointly hiring an infrastructure asset manager. We need to be very clear on the type of assets that we would consider, the exposures that we are willing to take, our appetite for risk, and our expectation of returns. And all of these need to and will be documented in a proper investment strategy. We also need to give careful thought to our governance structures and ensure that we have the highest standards of governance and risk management practices in place. And we need to do all of this at the outset so that we have a structure that will stand the test of time and be robust, yet versatile and flexible as conditions evolve. And I'm very pleased to report that the World Bank has agreed to provide us with the necessary technical assistance in order to do this. They are in the process of procuring a consultant for us who would work with us to explore all the options so that we can come up with an optimal structure.